Hi, everyone. I'm Brien Lundin of Gold Newsletter, and I'm speaking from the Toronto Metals Investor Forum. It's an exciting market, lots of opportunities, and one of those opportunities is Epic Gold, and has kind of a reset with the company. I have Rod Husband, the president and CEO of Epic, with us. Rod, a lot to talk about in this company, and in the big value proposition, investing proposition, has been the fact that you've got more money than you've got market cap. And that's, in this kind of a market, that's amazing. The market is inefficient. It overlooks things here and there, but tell us how you've got so much cash and securities value relative to your market cap. How did that evolve?
Yeah, sure. We made a decision to pivot out of Newfoundland about 6 or 8 months ago, and started to talk with the one natural buyer there, Newfound Gold.
Yeah, and you had a project right along trend.
Exactly, right on the Appleton Fault, right next to them. We had some interesting drill results, but just they weren't hanging together well enough, so it was a little bit tough. They came out with their PEA study, and one of their pits actually, the pit pushes into our claims a little bit already. So we knew that they were probably interested. So we took that as an opportunity. It was very high cost exploration there. So we had been looking for other opportunities, found a couple in Quebec and Ontario, and took that opportunity to offer up our claims and did little negotiations. They agreed to give us a block of stock. We knew that's how they did things because they took Labrador Gold out. And so we did a deal with them that at the time was about $7 million worth of their stock. Since then, the gold price ramped up, and so did their share price. So now it's worth about $11 million. We have one claim that is still, it's in dispute. And if we get it awarded to us, that'll lead to another $3 million worth of their equity. So we have potential for $14 million equivalent from them, and we're sitting on about $3 million in cash. So,
you were well funded even before that.
So we're 17 up to 17 anyway in cash, 14 million market cap, and the reality is the market hasn't grasped that yet because the negotiations from the time we did the deal till the time we closed the deal, that was several months. It just happened. The shares will be free trading the first week of April, so that's when we'll officially be fully funded with the cash and equivalents.
Okay. And so that's really not enough. And I think the market says that. You've got cash, but junior mining companies are all burning matches. They have to find something, build value out of the ground. And what I was impressed with in your presentation earlier is the projects that you have, the suite of projects you have, and how exciting they are, the potential upside. I had looked at them, quite frankly, as small projects that were somewhat constrained, but they're anything but that.
Yeah, they were, again, timing was everything for us. We got an opportunity to acquire by option, to purchase 100%, to earn 100% from Cartier. Because they had done their deal with Agnico Eagle that came in and bought 19.9% of the company and told them exclusive focus on the Chimu mine property.
Okay.
So they had these 3 properties that were good, but they were clearly secondary to them now. So we picked them up. Gold was ramping up, so it was time to look at them sort of with a different level of gold price in mind. They had small historical resources on them. They had been explored using target-based exploration, where people they cared about, they hit a drill hole, they step out, hit a drill hole. And then they miss. And then they don't spend enough time figuring out why or what system they were looking at. So one of the first things we did, and we've got a pretty strong technical team, was take a step back and look at what the systems were at play. And turns out in the Abitibi, there's often multiple systems. It's not just orogenic or just VMS.
So they can actually overprint.
Exactly.
Right. Okay.
Exactly. Be a combination of those. So that was the first thing we did. Then we had to relook at the resources using current gold price because they were done on 3 of the properties. They were done in the late 90s and 2000. So if you take gold price at the time, $1,000, $1,200 they were using.
It takes a pretty high cutoff grade to make that work economically.
Exactly. Do it today, cutoff grade drops. All of a sudden, there's a lot more gold in the mineralized envelope that's potential for economics. So You take a little 50,000 ounce deposit, that target now becomes 500,000 ounces. And it's a very small area on the property.
Yeah.
There's multiple signatures, both geologically and geophysically, very similar to the existing deposit. And then there's also some confirmation work that's been done on surface samples, even on a couple of drill holes.
Yeah.
But no real follow-up work. So we said, okay, we have a very interesting target. We have, a very interesting resource. And then we have several targets that have the ability to provide the same kind of resource. So we went in on the one project on Fenton, drilled 10 holes already, 4,200 meters to test 6 of these other lookalikes. And if we hit one there, we really have a substantial target at Fenton. And then Wilson, same thing. It's a very small 50,000 ounce resource. It's had 22,000 meters drilled since the resource was found, but nobody's spun that around and figured out what's there.
Right.
So we're doing internal studies on it. Think we'll have the same kind of thing. Did some reinterpretations on the system and the geology around the system. And now we've got a very tight set of folds with gold showings and drill holes all the way along the contact zone that's been folded. So it's changed from spotty sort of chimney style targets to now we have a continuous, very long strike length that needs to be tested. So permits are coming there. We'll get in probably this summer into Wilson and do the same sort of 4, maybe 5,000 meters of drilling there with the same kind of upside. We take a small 50,000 ounce resource that has potential to be 500, multiply that by 1 or 2 times along strike.
Yeah, and I think, frankly, that's where I made the mistake is I looked at the projects, the small resources, and number one, it illustrates why you don't create a resource, develop a resource, and show the market that because it presents a limiting factor. You look at it, that's all it is, and really for 2 reasons. You have a 250, 300,000 ounce resource. You imagine that's all it is. Well, you lower the cutoff grade relative to today's prices, and all of a sudden it's a 500,000 ounce resource with the potential to multiply because nobody's really done that work to establish it along trend or the multiple centers.
Yeah, correct. And to that point, 500,000 ounces in the right neighborhood
at these prices
is like 3 or 4 million ounces in a remote area.
Right.
Because we don't have to build in where we are in Quebec. There's so much infrastructure around us in terms of processing facilities that are, some are on care and maintenance even that aren't even in use. Some are in use but underutilized. So if we can find enough that's economic to dig out of the ground, we can take it to a mill.
So that means relatively little CapEx. You just basically have to dig the hole in the ground and
So economics becomes very important, right? You got to think about what's it going to take to.
Right. So you have holes in the lab right now, results coming out soon. I know you had to resubmit those holes because there were indications that you wanted to get fire assays or metallic assays.
Yeah, a metallic screen. So we're in an environment where there's coarse gold, and a couple of samples that we sent in originally, the lab came back and said they identified coarse gold. So we just said, okay, hold off on sending us partials. Resubmit all the samples. Let's do metallic screens for them so that we know we catch all the gold. And so in 4 to 6 weeks now, we'll have our assays back and we'll know exactly what the numbers are.
And where were these holes? What was the goal with these holes?
They were drilled on Fenton, and they are to find a Fenton lookalike.
Okay, right.
In one of the matching signature sort of geophysical, geological.
So these are really high potential holes.
Yep.
These are exploration holes that if you hit on those holes, you will show the market the potential to take that existing resource, which is much larger at current prices, and essentially multiply the number of targets, potential targets or potential deposits along the way. How much is this costing you, and how is that going to be draining or potentially take down that cash and securities?
Yeah, at the end of 2025, we did a charity flow through round that was backed by 3 institutional types in Quebec, Sidex, NQ, and another one. They were the back end of a charity flow through, so we raised about plus a small flow through. We did about $2 million in flow through funding there. That's more than funded Fenton. We have some extra that will go into Wilson to start. So we spent now on Fenton somewhere between 1.5 and 1.8 million to drill those holes. We'll still have a little bit that needs to be spent, but we're well funded. The plan at Wilson will be similar, another 1.5 million, and then the third project, Benoit, needs to be drilled in the winter and ice, so it'll be at the end of the year, rolling into 2027.
So good bit of work coming up. I think the odds of you having more cash in your market cap, of that lasting much longer, are pretty slim. Again, the market overlooks opportunities in this junior mining share market. This is one of those opportunities, primed for a big re-rating, drill holes coming in that look very interesting. So, Rod, thank you so much for sharing this with us.
Thank you, Brian. Appreciate it.